by devaluing the dollar by 50% against the yen and the mark. By 1990, the trade deficit had come back into balance.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. Today, before I begin, just a reminder, go to wealthformula.com. If you haven't done so and you are an accredited investor, join the Accredited Investor Club. Lots of things coming in there in Q4, lots of tax mitigation strategy, related investments, that kind of thing. Take advantage of 100% bonus depreciation, take advantage of discounted assets, and so on. So again, wealthformula.com. Now, let's talk about today's show. Interesting one. It's with Richard Duncan again, and he's an interesting guy. And I wanted to talk to him because something big is happening in Washington right now, as you know, and it has the potential to reshape everything you and I do as investors. As you may know, and as I'm sure you probably know, a few weeks ago, Trump administration attempted to remove Fed Governor Lisa Cook, only to have appeals courts block the move on legal grounds. And at almost the same time, Stephen Miran, one of Trump's economic advisors, was confirmed by the Senate to the Fed's Board of Governors. And on one side, an attempted a subtraction, on the other, a confirmed addition. All of this is happening right before a major policy meeting, which by the time you hear this is going to be concluded, which is the announcement of either a 25 or 50 basis point cut. You tell me, because I'm doing this right before that meeting. Trump's takeover of Fed is, really not a question of if, it's a question of when and how, and whether it unfolds in a matter of weeks or drags out over the few months. The direction is set, and the outcome really, in my view, is inevitable, right? The end game, what is the end game? The end game is to bring interest rates down, and if necessary, use quantitative easing to drive bond yields down as well. And that kind of policy, what would happen? It would basically flood the system with liquidity. An immediate effect would be booming to the economy, right? Asset prices would rip higher, stocks, real estate, gold, Bitcoin, you name it. If you own assets, you will feel wealthier overnight. But of course, there's another side of this coin. A dollar that weakens under the weight of easy money, a gap between the asset rich and the asset poor that grows even wider. Rising inequality, rising tensions, and perhaps a long-term cost to credibility of the U.S. financial system. So the question is, you know what? This whole takeover thing, it sounds, it sounds sneaky. It sounds bad, especially if you listen to mainstream television. But is it such a bad thing? The takeover of the Fed? That depends entirely where you sit. If you're a wage earner with no meaningful assets, if you're poor, it's bad news. If you're an investor, it's a reminder that ignoring policy shifts like this is done at your own peril, because the time to prepare is now. Don't wait for rates to drop before acting. History shows that buying assets in a descending rate environment is one of the most powerful wealth creation maneuvers in the history of the United States. All you have to do is look back at 2008. The Fed responded to the financial crisis with unprecedented rate cuts and waves of quantitative easing. And what followed was more than a decade of explosive gains in stocks, real estate, and other assets, which basically just ended. I mean, gosh, right? So those who bought while rates were falling built extraordinary wealth, and those who stood on the sidelines missed out. And that is playing out in real time again, in my opinion. But don't take my words for it. Listen to Richard Duncan. He is clearly not a pro. If you've listened to him in the past, he calls balls and strikes. And if anything, he's been sort of not on board with the Trump administration, the plan, but listen to what he has to say about this. We'll have that interview right after these messages.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Richard Duncan. He's been on the show several times before. He's an economist and author known for his work on the global financial system and credit dynamics. He's the creator of Macro Watch, which is an online video newsletter analyzing economic developments, and the author of several influential books, including The Dollar Crisis, The Corruption of Capitalism, and The New Depression. How you doing there, Richard?
Great, Buck. Thanks for having me back on.
Yeah, nice to talk to you. You're in Thailand, right?
That's right.
That's right. Well, good to connect. It's a sort of an unusual time. I think my time here is now 6 p.m. and it's 8 a.m. your time. So that it's interesting how the business ever gets done between those two countries. But anyway,
it's hard doing this podcast with the strange hours between here and there.
Yeah, absolutely. Well, let's talk about some of the things that you've been talking about. First topic, I think, that you've been sort of talking about is will Trump and the Fed? And so you have a video where you ask that question and you say that the Fed independence could be coming to an end. Tell us what that really means. Tell us what the background is here.
Right. Well, yes, let me begin with the background.
Yeah.
Because we really are living in extraordinary times as far as developments in the U.S. and the global economy go. President Trump is very serious about remaking the American economy. When he says make America great again, he means it. And his plan to do that is to reindustrialize the United States. And to do that, he has a strategy. There's a very clear plan. In fact, this plan is laid out very clearly in a paper published by Stephen Miran, who is the chairman of the Council of Economic Advisors and who has just become the next Fed governor. He's now a Fed governor, nominated by Trump and approved by the Senate. So in this paper by Stephen Miran, he lays out a three-step strategy on what Trump intends to do, what Trump should do regarding tariffs. And this paper was published in November last year. So the three-step strategy is, first, put very high tariffs on all the United States trading partners. Second, threaten all of those trading partners. If they retaliate, threaten them that the United States will no longer defend them militarily. And then the third step is to then convene a meeting of these intimidated allies and pressure them into devaluing the dollar. Something like we saw at the Plaza Accord. This would be called the Mar-a-Lago Accord. So actually, that's what's been happening. This has been a very clear blueprint as to what's going on. We put on the very high tariff, step one. We've threatened to remove our military protection if anybody retaliates. That's step two. Both those things are done. And so now they're probably working on step three, which is devaluing the dollar.
Hey, can I interrupt you, Richard? In order to devalue the dollar, though, isn't that as much just I don't know what the other nations would they just relative to ours, they can just go in and step and devalue the dollar? Or, I mean, don't the markets sort of dictate that?
The markets play a role, and we'll come to that in a moment. But
yeah,
in the Plaza Accord in 1985, the U.S. got Japan and Germany to agree to devalue, to allow their currencies to appreciate by about 50% against the dollar. So the dollar was devalued by 50% against the yen and the mark in order to try to bring the trade deficit back into balance. By 1985, the trade deficit was running out of control for the first time. And this worked. By devaluing the dollar by 50% against the yen and the mark, by 1990, the trade deficit had come back into balance. And these were more or less brought about by government intervention rather than market forces.
Yeah, it's I guess the mechanics may be beyond the scope of what we're talking about, but I was just curious on how that works.
Yeah, so what Trump wants to do is to, as I said, reindustrialize the United States, but as part of that, he wants to bring down the U.S. trade deficit, bring the trade deficit back into balance. And here is where things become very dangerous. trade between countries had to balance when the world was on a gold standard, or even the Bretton Woods system. Because under a gold standard, if a country had a big trade deficit with another country, it had to pay for that deficit by shipping its gold to the other country. And gold was money, so pretty soon that country would run out of gold and they would have to stop buying things from other countries, and trade would come back into balance. So as long as the Bretton Woods system was in place, the U.S. didn't have a trade deficit. But soon after Bretton Woods broke down in 1971, by the early 1980s, the United States started running a very large trade deficit with other countries, with the rest of the world. And in fact, this trade deficit became so large. Last year, it was $1.2 trillion. This became the driver of global economic growth. It created a global economic revolution. It ushered in the age of globalization. It allowed the trade surplus countries like China to grow into a superpower. And altogether, the cumulative U.S. trade deficit since 1980 has been about $17 trillion. So that's thrown $17 trillion off into the global economy and created very rapid global economic growth. And it's also supported U.S. economic growth, because by buying things from other countries with very low wages, like China and Vietnam and now in Bangladesh, that's very disinflationary. So that drove down inflation rates from the double digits in the early 1980s to very low levels before COVID struck. And that allowed U.S. interest rates to fall to very low levels. Very low interest rates helped the U.S. economy in numerous ways, and it also pushed low interest rates allow asset prices to rise, home prices and stock prices. So that helped the U.S. economy. Low interest rates helped the U.S. economy. And at the same time, the countries with the trade surpluses who were accumulating dollars had to invest those dollars back into U.S. dollar-denominated assets. Because when they sell things in the U.S., they're paid in dollars. They take the dollars back to China or wherever they came from, but they've got to do something with the dollars. And what they do with them is they buy treasury bonds, or they invest them in the U.S. stock market. And so this massive inflow of foreign capital was the direct result of the trade deficit. And the capital inflow pushed up bond prices, and that drove down interest rates. It also pushed up the stock market and created more and more wealth. So now the problem is we have a big global economic bubble that has resulted from these trade deficits. We have a big credit bubble around the world. If you bring the U.S. trade deficit back into balance, it's going to cut off the fuel that has allowed that bubble to form. The dollars going off into the world economy as a result of the U.S. trade deficit are the bubble fuel. If you cut off the trade deficit, dollars stop going overseas, and the capital inflows stop coming back into the U.S. So you get in a situation where, without the capital inflows into the U.S., that would mean less foreign buying of U.S. government bonds, so less upward pressure on U.S. bond prices, and that would mean less downward pressure on government bond yields.
Let me interrupt you again, Richard, just because I think some people, we get in these conversations, and sometimes there's some basic questions people have, and one of them, the way you describe the trade deficit, when I'm listening to that, it's like the thing that comes to my mind is, why do we care if we had a trade deficit if we were benefiting from it in the first place?
So that's a question for you to pose to President Trump.
Well, so the idea, his idea then, is it not that the issue with the trade deficit is it's basically robbed us of manufacturing? Is that the main driver from President Trump?
Yes, that is. And he's right to point that out. That is the reason that U.S. manufacturing has been hollowed out since the 1980s. And this has left behind the American middle class, whose relative well-being has stagnated since that time. And those are the people that support President Trump, many of the people who support Trump. And President Trump has said he's going to end this deindustrialization of the United States and reindustrialize the United States by putting in place very high tariffs.
So what do you see happening here? Miran gets in there. Okay, obviously that's not control of the Fed, but I think one of another video that you had talked about the Fed's final days. So talk a little bit about that, if you would.
Because the reason it's so important for President Trump to take over control of the Fed, which he's on the verge of doing, is because his policies are very inflationary. By putting up high tariffs on all of the goods being imported in the United States, this is going to cause the inflation rate to move higher. And by trying to reindustrialize the United States, that will mean more factories will be built in the U.S., or more Americans will be working in those factories. And this is happening at a time when the administration is also deporting very large numbers of people. So we have a labor shortage to start with in the U.S. The unemployment rate is only 4.3%, which is very near historic lows. So if you do these things in combination, it's very likely the tariffs will create the first round effect of higher goods prices. And then when you begin reindustrializing the country, that will create a second round effect of higher wages and higher prices. And this is going to push up the inflation rate. And at the same time, if you have less capital inflow coming in from abroad, that's also going to put upward pressure on bond prices, making it more difficult to finance the government bonds at low interest rates because there'll be less foreign capital coming in. So it's very important for him to take control over monetary policy, because if the inflation rate starts to move higher, continues to move higher, the low was 2.3% in April. The Fed's target is 2%. And last month it moved up to 2.9%. So it's moving higher now, and it's likely to continue moving considerably higher, in my opinion. Normally, when the inflation rate is moving higher, the Fed would hike the federal funds rate and push interest rates higher, policy rates. But President Trump doesn't want the interest rates to go higher. In fact, he's been very clear that he wants interest rates to go much lower. The federal funds rate is currently about 4.33%. He said he'd like for the federal funds rate to be much closer to 1%. So if he takes control over Federal Reserve policy, monetary policy, he can have the FOMC vote for considerably lower interest rates on the federal funds rate. Then he's very close now to taking over control of the Federal Reserve.
So far, Richard, and maybe this is a function of time, inflation ticked up a little bit. It didn't seem to be that dramatic. Is it simply because, in your view, tariffs have not been in place long enough?
Yes, I think that's right. The tariffs have not been in place long enough. Many companies stocked up on inventories when they knew that higher tariffs would soon be in place, and they've been buying down those inventories. But now the inventories are running out, and they're going to either have to choose between taking a hit to their profits, and presumably therefore also to their share prices, or passing on the higher cost of the imports to the consumers, meaning higher prices and higher inflation.
Similarly, the bond markets actually have, the 10-year's gone down. Talk about what's going on right now with the bond markets compared to what you think's going to happen.
So this is interesting because last year, the federal funds rate 3 times in September, November, and December. But from the time the Fed started cutting, the 10-year bond yield has actually moved higher. It's still higher now than it was in September last year. The 10-year bond yield has been moving lower over the last couple of weeks ago. I think in anticipation, one, of the fact that the Fed is now expected to cut the federal funds rate at its FOMC meeting on September 17th by 25 basis points, but also by the realization that once President Trump does have complete control over the Fed, over U.S. monetary policy, if he's going to cut, he's going to instruct the Fed to cut interest rates radically.
Right. But how does that affect, how does that affect the bond markets, which, are not really under the control of the Fed? Because, what I was referring to something that happened recently. Obviously, what you were talking about with the Fed funds rate going down, the bond markets going up, and, for regular everyday business people and stuff, a lot of the interest rate that we pay is mortgages, for example, are based on the bond market more than they are the Fed rate. So that's a problem. But this time around, with the anticipation of the Fed rate being cut, the bond markets actually went down too, simultaneously, and maybe because of this fact. But there was a significant adjustment to the labor market, to jobs market news. I think they basically showed in the last few months there was almost a million jobs less than they thought. Is that the reason, do you think, that the bond market reacted the way it did?
Yes, I do think that is part of the reason why the bond yields are moving lower, because of the downward revisions to the job numbers. But before I really answer your question fully, let me explain what is going on in terms of the president gaining control over the Federal Reserve. So the Federal Reserve is made up of a board of governors, 7 governors based in Washington, D.C., and is also made up of 12 regional banks. Each regional bank has a president. So there are 12 presidents of the Federal Reserve regional banks. 8 times a year, the Federal Open Market Committee meets to vote on interest rates and also on the size of the Fed's balance sheet. In other words, quantitative easing or quantitative tightening. Now, here's the thing. The 7 governors always get to vote at every FOMC meeting, but only 5 of the regional presidents get to vote at these meetings. So there are 12 votes in total, 5 presidents of the 7 governors. The rules are, if there are 4 Fed governors out of 7, a simple majority, 4 out of 7, then those Fed governors have the power to fire any or all of their Federal Reserve Bank presidents. And they also then have the right to approve the replacement of those Fed presidents. So what this means is, if President Trump can appoint 4 of the 7 Fed governors, or if he has influence, if they are on his side and do what he wants them to do, then he can, in theory, fire all the Federal Reserve Bank presidents and appoint new ones. And the new ones, they would have 5 votes on the FOMC at every meeting, along with the 4 governors that support him. So that would give them a 9-3 vote in every FOMC meeting.
Does he have that kind of, I guess, in terms of the governors that are on there right now, do we know if they're generally pro-Trump agenda right now? I mean, because obviously you're going to it would require them to make that maneuver against the presidents, right?
Right, and we do know precisely. In the most recent meeting, Christopher Waller dissented, and also Michelle Bowman dissented. Both of those people are interested in replacing Chairman Powell as chairman of the Federal Reserve when his term expires in May. And they are, we can say, on Team Trump. The Fed voted to hold interest rates steady, but they dissented. They voted to cut the interest rates in line with what President Trump wants to happen. Now, very recently, the President Trump just nominated and the Senate approved Stephen Miran to be the 3rd Fed governor. So that's 3 votes for Team Trump. And President Trump last month fired Lisa Cook, and claiming that he was firing her for cause because of fraudulent mortgage applications. Therefore, if he succeeds in firing her, then he will replace her with a 4th Fed governor. And then he will have 4 out of 7 Fed governors on Team Trump, and they would then have the right to fire all the Federal Reserve Bank presidents or any that dare to disagree with Trump's policy. So once he has 4 governors on the board, which will happen as soon as he can get rid of Lisa Trump, then he will have complete control over monetary policy. Now, bringing this conversation now back to your question about the bond market and bond yields. Normally, if the Fed were to cut interest rates sharply, as the president wants, at a time when inflation is moving higher, as it is now, and is expected to continue to do, this would cause investors in the bond market to become very alarmed, because they would expect that much lower interest rates would overheat the U.S. economy and lead to even higher rates of inflation very quickly. So they wouldn't be willing to buy U.S. government bonds at current yields because they would expect higher rates of inflation. They would demand higher interest rates on government bonds. And just for example, no one would want to buy a 10-year government bond yielding 4% if the inflation rate is 5%, something more like 7% yield. So here's why it's so important for the President Trump to get control over the Fed and over monetary policy. Because if he wants them to slash the short-term interest rates to much lower levels, but that would tend to be inflationary, and that would tend to push up bond yields. But when the bond yields start to rise, if the president has control over monetary policy, then he can instruct the Fed to launch another round of quantitative easing.
Right. So basically buying up the bond market and driving those interest rate, ultimately the yields down. Yeah.
That's right. There's no limit as to how much money the Fed can create, so that if instructed to do so by the president, the Fed could begin creating dollars and using those dollars to buy up government bonds. And they could do this until the bond prices rise and the bond yields fall to any level the president desires. And I think this is the scenario that will ultimately play out here once President Trump has control.
So going back to the paper that Miran wrote, okay, so that effectively that's kind of the plan, right? So you bring down the Fed rate by getting control. You do quantitative easing to bring down bond yields, and that creates a recipe for significant growth because of low interest rates, business, real estate, across the board. So then the theory, I presume on the Trump side is, we do that, we grow at an enormous rate, and to hell with inflation at that point because we're going to be growing so fast. Is that kind of the theory then that you think that they have on the Trump side?
I think so. And yes, the inflation rate could certainly move significantly higher, but it's not certain that the government would actually report the actual true inflation numbers, because after all, the president has recently fired the head of the Bureau of Labor Statistics because he was unhappy with the job numbers that she released a couple of months ago. And so government employees are going to be very reluctant to report any inflation numbers that the president wouldn't approve of. So it's not sure that the government would be reporting the true inflation numbers. But this scenario that we just outlined would create an extraordinary economic boom in the U.S. And the much lower interest rates and the quantitative easing would also drive up asset prices. It would create a stock market boom, make home prices go much higher. All the asset classes, gold, cryptos, everything would move, except
and the dollar would weaken significantly.
The dollar would crash. That's right.
And that goes back to the part of the Miran paper you cited where he was talking about essentially, even more devaluing it relative to various currencies.
That's right. This Miran paper had two main parts. Chapter 3 was about tariffs and the tariff strategy. Chapter 4 was titled Currencies, and it discussed various strategies to devalue the dollar. One was part of the tariff strategy we've already discussed, forcing our partners into a Mar-a-Lago accord and agreeing to a lower dollar. But he also discussed unilateral approaches to devaluing the dollar. For instance, he said that the Fed could create money and buy foreign currencies, accumulate foreign currencies, and push up the value of the foreign currencies and thereby drive down the value of the dollar. This is essentially what other countries have been doing to the United States for decades, buying up dollars and accumulating foreign exchange reserves and pushing up the value of the dollar. So this would turn the tables on them. That's one approach. He also suggested the United States could impose a tax or a user fee on the treasury holdings of foreign central banks. So rather than paying foreign central banks interest on U.S. government bonds, as is their right, he proposed withholding some of that interest as a tax in order to encourage them to sell their treasury bonds and to reduce their dollar holdings, which would drive down the value of the dollar. So, and he discussed the importance of a correct sequence: tariffs first, and then the currency devaluation second, because the tariffs give the United States leverage over its trading partners. So we've had the tariffs now. It looks like the dollar devaluation is the next phase.
So the net result of this, from what I can tell, would be ultimately, significant, a significant asset bubble, right? Like significant growth in asset prices. So those benefiting would be people who already owned assets. Those, you have an increase in disparity in wealth. Tell me the big problems that you see with this, with this happening, with this. If they get what they want, obviously they think it's the right thing for the United States. They think it's what's going to make America great again. My sense is that you don't believe that. So tell me why.
Many things would happen. The wealthy would become wealthier, but I think the average Americans would also benefit from higher wages as the reindustrialization of the country takes place. They would receive higher wages, and the country would be significantly reindustrialized, which would be a very good thing. We can't depend on other countries, especially potential enemies in the next war, for our steel and to build our ships and for pharmaceuticals and all the other things we need, much less computer chips. So I think the reindustrialization of the United States is a very good idea. I think it would benefit all Americans. Of course, the rich always benefit most in every environment, unless it involves much higher taxes on the rich, but that's not on the cards. So I think the reindustrialization would be a good thing. Now, the problem is that this would probably create such a big economic boom that would last for several years, but ultimately this boom / credit bubble / asset price bubble, every boom ultimately pops. And then a few years down the road, we would probably have a new systemic financial sector crisis. The leverage would become extremely high. Ultimately, the U.S. private sector would run into difficulties as it did in 2008, and it was unable to repay its mortgage obligations. And then the banks would begin to fail and cascade into a new systemic financial sector crisis. So that's the threat, that we get a big boom and then we get a big bust. But there is hope that there is a way to avoid that. And that's one other element of this strategy that we haven't really discussed or hit on yet. Now, once the president gains complete control over the Fed and complete control over monetary policy and begins using quantitative easing to push down bond yields, it won't take him very long to realize that he can also use the Fed and money creation to fund his U.S. sovereign wealth fund. As you know, President Trump created a U.S. sovereign wealth fund in February through an executive order. And having the Fed create money and use that money to invest in new industries and new technologies on a very aggressive scale could actually induce a technological revolution in the United States that would create a productivity miracle and turbocharge U.S. economic growth, actually restructuring the economy. If he had his U.S. sovereign wealth fund financed by the Fed on, say, $1 trillion or multi-trillion-dollar scale over the coming years, then the U.S. sovereign wealth fund could do things like invest in artificial intelligence, but not only that, in developing energy capacity so that the energy is available for the data centers that are necessary to run the AI. He could invest in things like developing fusion, which could ultimately, in the not too distant future, lead to much lower energy cost, and invest in things like quantitative robotics, genetic engineering, biotech, nanotech. And by investing in these new industries on an aggressive enough scale, it could create a long-lasting economic boom fueled by a new technological revolution. And that could actually see us far a decade or two into the future if carried out on an aggressive enough scale. So we're looking at an additional move into state-directed capitalism. which we've seen Trump pursue already through a number of ways, creating the U.S. Sovereign Wealth Fund, taking a 10% equity in Intel, getting other countries to agree to give the United States money for President Trump to invest in any way he sees fit, taking a golden share in U.S. Steel. All of those areas are clear examples that the president is interested in state-directed capitalism. And if done right, this could actually be a very good thing for the United States. This is what China has been doing for a very long time. And China has been so successful at it that they are now a very serious threat to U.S. national security. China is a technological superpower, and China is investing through their government more in new industries and technologies than the United States is. And we're now neck and neck in the race for AI dominance. Whoever develops artificial general intelligence first, or super intelligence, is likely to end up ruling the world. And there's a real chance that's going to be China. Therefore, we need to take extraordinary measures to make sure that that doesn't happen. And this is an opportunity for us to do that. And I believe President Trump may very well take advantage of this opportunity. This seems to be the direction in which things are going. I believe that would be a good thing.
All of this sounds very positive to me. What's a downside here? I mean, you mentioned, an asset bubble, and ultimately that corrects. But I mean, that happens in cycles where there's booms and busts. I mean, what should we be concerned about in this scenario other than a significant loss of the value of the dollar?
Of course, there are always many things to worry about. One is increasing income inequality. It won't be long now before the United States has trillionaires. And we've already seen the political power that people with $100, $200, $300, $400 billion can bring to bear on elections. If we have, even at where we are now, it undermines democracy and creates an oligarchy. And that is not good for democracy. And this would lead to even greater income inequality for London. Also, the unprecedented aggressiveness of President Trump's maneuvers are also consolidating power in the office of president in ways that we'd never seen before. That could set precedents that establish a trend that lead to even greater consolidation of power under the executive branch in years ahead in ways that might turn out to be very undesirable.
Historically, Richard, are there examples where central banks have lost their independence and, what we've seen happen in those situations?
The United States had a central bank before the Fed, and it was ended altogether by Andrew Jackson, I believe in the mid-1830s. And between the mid-1830s and 1913, when the Fed was created, there was no central bank. And at that time, the Treasury Department carried out many of the functions that the Fed now carries out. For instance, during the Civil War, and again in the 1890s, the Treasury Department created money on a large scale and used it to fight the Civil War and for other purposes in the 1890s. So that's one example of, you could say, not only the central bank losing independence, but it was destroyed altogether and replaced by the Treasury Department.
So, from a practical standpoint, Fed loses its independence, and the net result of what you have kind of laid out for us ultimately being sort of devaluing of the dollar. It seems to me that when investors, if they believe that to be true, the best way to protect themselves is to own assets. Is that fair?
But yes, that's fair. That's right. They can own assets, or they can sell their dollars and buy yen or buy euros. That's another way to protect themselves. That is the purest play. If you try to become very clever, then things become quite complicated. If you expect a sharp dollar devaluation against the yen and the euro, the purest way to play that is to buy the yen and the euro.
I don't think I've seen you necessarily talk about this. This other issue that's been on my mind is the in terms of artificial intelligence, you've talked about sort of the, that this is fundamentally going to change the world. Whoever controls AI controls the world. One of the things about AI is that it is almost certainly a deflationary technology. How much, where does that play a role in the economy? How do you think that's going to come together in the next 5 years?
We're almost certainly right that it would be deflationary over the longer run, but it may be inflationary in the short run in terms of driving up energy prices. For instance, the big tech companies now are investing so much in data centers. I believe I've read not long ago that the 4 or 5 largest U.S. tech companies are investing close to $400 billion next year in AI, according to their announcements. That's more than the European Union spends on its military in total. That just puts this into perspective. And what they require is energy, new energy sources. The United States doesn't have enough energy capacity currently to allow these data centers to get all of the energy that they need. So we're likely to see energy prices, electricity prices moving higher. We're also likely to see a great deal of construction of new types of energy production. Both those things, along with the investment into AI by these big companies, could all push high prices higher in the near term. And China, for example, has been very clever. Since 2000, in 2000, the U.S. had about 3 times as much electricity generating capacity as China does. But China has expanded its electricity capacity by 8 times since then. And it now has 2.5 times as much electricity generating capacity as the United States does. And according to all reports, they're developing new nuclear facilities, nuclear power plants very aggressively, whereas the United States has not done that for decades. So we're really behind the curve in terms of having the electricity generating capacity that we need to compete with China. And that's going to have to be ramped up or we're going to lose this AI war. And that's going to put upward pressure on a lot of different choices.
You talk a lot about tracking credit. That's a big part of the way you see the financial world. So what are some of the key signals you're watching right now that could show us where this is headed?
I always watch the total credit of the U.S. You can say total credit is the flip side of total debt. One person's credit is another person's debt. So the easiest way to measure total credit is by measuring total debt. The data is more available. And this means the debt not only of the U.S. government, but also of U.S. households and corporations, Fannie Mae and Freddie Mac, and the financial sector. So the total credit number first went through $1 trillion in 1960, not 64. And now it's something like $150 trillion. We're approaching, I'm sorry, I haven't looked at the number recently, but it's just absolutely exploded. Well, it's much closer to $100 trillion last year. So now it's about $105 trillion, moving toward $110 trillion. So it's been this credit growth that exploded once dollars ceased to be backed by gold, that unleashed the amount of credit that could be created in the U.S. and in the world. And this credit explosion has fueled economic growth globally. I always say that capitalism, which was driven by saving and investment, has been replaced by what I call creditism. Our current economic system, is driven by credit creation and consumption. So credit growth is absolutely essential to economic growth. And this explosion of credit is the reason that the world looks the way it does now. When I look out my window here in Bangkok, I can see hundreds of skyscrapers that were not there 20 years ago. And these are the direct result of this new economic system that's involved in an explosion of credit globally. And that's created an enormous wealth boom. The most recent data for wealth in the United States show that the total wealth in the United States, household wealth, so this is all of the assets of all of the Americans minus all of their debts, it increased by $9 trillion during the second quarter alone. And it's currently the total number now is $176 trillion of wealth in the United States. $60 trillion in the last 5.5 years. It's up 50% in the last 5.5 years. Let me repeat that. It's up $59 trillion. Total U.S. government debt is $37 trillion, depending on how you count it. But this is practically enough to pay off all the U.S. government debt twice over. This is the creation of wealth in just the last 5.5 years. So there's an explosion of wealth. The problem here is that if you compare the level of wealth to the level of income, that gives you a ratio, the wealth to income ratio. So this is household sector wealth, which is now $176 trillion. If you compare that to disposable personal income, this ratio is now something like 780%, which is much higher than it's ever been before. The average going back to 1950 has been 580%. Now it's 780%. The only other times it's become significantly above its long-term average was during the dot-com bubble in 2000 and during the property bubble in 2008. Then it got up to somewhere roughly around 650. So now this wealth-to-income ratio is way out of line already, suggesting that the problem with this is if income is not high enough, it's very difficult to support the higher wealth levels because people need to have income in order to be able to pay the interest on their mortgages, for instance. If home prices are extremely high and income is rising, but income is flat, it doesn't take long before people no longer have enough income to be capable of paying the interest on their mortgage debt, and then attempt to cause a correction.
Is that a marker of income disparity as well? Because you're measuring the full wealth of the United States versus the average income, right? Or not
Yes,
average,
that's
but
right.
the income. So a higher ratio would indicate a higher income disparity. Is that?
That's right, and that's another negative about great income inequality, because when wealth is more equally spread, then more people have more income to be able to buy assets and buy them on an affordable and sustainable way.
Anything else that you think we ought to know right now about what's going on with this particular topic?
No, I think that's the big picture. This is truly revolutionary because what we're talking about is changing the way that the global economy works. The main driver of the global economy has been the U.S. trade deficit. Now the objective of the Trump administration is to eliminate that trade deficit and to reindustrialize the United States. This is a very big experiment. And to make this work, the president is pulling out all the stops to take over control over the Fed and U.S. monetary policy. And if he does, then perhaps he can pull this off in terms of using the Fed to invest in the U.S. sovereign wealth fund and stimulating U.S. economic growth, creating a technological revolution, a long-lasting economic prosperity. But it's a very big experiment. There's a real risk that this global bubble that has developed under creditism could implode with catastrophic consequences.
Yeah. Richard, it's been a pleasure as always. The newsletter, the video newsletter that you do is called Macro Watch. Can you tell us a little bit about that?
Yes, thanks. I started Macro Watch 12 years ago. Every couple of weeks, I upload a new video discussing something important happening in the global economy, such as we've been discussing today, and how that's likely to impact asset prices. These videos tend to be 20 or 30 minutes long and contain 30 to 50 charts that can be downloaded. So if your listeners are interested, they can find Macro Watch on my website, which is richardduncaneconomics.com. That's richardduncaneconomics.com. And I'd like to offer them a discount code that would give them a 50% discount if they would like to subscribe to Macro Watch. It's go to the website and hit the subscribe button. They'll be prompted to put in a discount coupon code. If they use the code formula, they can subscribe at a 50% discount. So I hope they will check that out. And at the very least, while they're there, they can sign up for my free blog.
Fantastic. Richard, it's always a pleasure. Thank you so much for your time and this conversation.
Thank you, Buck. I look forward to the next time.
You make a lot of money but are still worried about retirement. Maybe you didn't start earning until your 30s and now you're trying to catch up. And meanwhile, you've got a mortgage and private school to pay for and you feel like you're getting farther and farther behind. Good news. If you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator. It can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Hope you enjoyed it. And the moral of the story, buy assets and don't sit around in cash because, as Robert Kiyosaki says, savers are losers. Money, dollars are going to not be worth nearly as much as they are right now in just a matter of a few years. So get off the sidelines. You have a descending rate environment. Do something. If you want to, join our Credit Investor Club. Get exposure to some deals there at wealthformula.com. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.